Hey everyone, welcome back to Learning About Loans. With me today, Mr. Justin Wood. He's amazing, he's incredible, and awesome and wonderful. Justin and I have worked together for coming up on 10 years, which has been amazing, and he is the man. So today, our topic, if I'm not mistaken, Justin, is going to be bank statement loans. Is that correct?
Yep, bank statement loans. You got it.
So what does that mean? Every loan, we not every loan, but a lot of loans we need bank statements. But in particular, we're talking about using bank statements to determine income instead of tax returns. So fill me in, like when, who can do it, what do we need to do, and what do we need to know about these bank statement loans?
Yeah, and hey everybody, thanks Mark for having me today. Bank statement loans, why do they come up, right? Well, most of the time, and we see this a lot, it's designed for self-employed buyers. When they have tax returns, they reported a ton of money, but that was gross, right? It's not what they made at the end of the year. So how
In
those
other
come
words,
up?
the tax returns, a lot of, so first question, do they have to be self-employed to do this bank statement program?
They're ideally designed for self-employed buyers and customers based on the nature of the income, but not necessarily.
So somebody that's going to go in and be a W-2 person, um, that's a salaried employee, they can do this as well.
They can, yes, if it's in tandem with like a co-buyer, for example. So someone may be self-employed, maybe someone's W-2, you can combine their income with this bank statement program.
Got it. So in other words, let's just take a husband and wife. We'll just say husband is the W-2 job, wife is self-employed. You can still do the bank statement program, even though not both are self-employed. But do you need at least one person on the loan to be self-employed?
Traditionally, yes, 99% of the time, it's exactly right. Somebody's got to be self-employed.
And the benefit of the bank statement program is that you show the bank statements, but you have to show like any income documentation? Like, do you have to show tax returns or pay stubs or anything like that?
No, and that's not how they're designed to operate. They're designed to operate with bank statements only, no tax returns, no W-2s, and no 1099s.
Wow. So how do they need to prove they're self-employed? Like, how come if that's the case, like, what if Joe Cutesy decides to try to come into us and get cute? He's a W-2 salaried guy getting a loan by himself. How do we know he's self-employed? How come how do we know he can't just give us his bank statements and do it that way?
The way we get around that and really address it for all bank statement programs, you got to have a CPA letter confirming
Hmm.
ownership, business establishment date, and that it's in good standing, right? That it's still operational.
What if they don't have a CPA? So I'm now truly I'm self-employed and I'm not going to go to Joe trying to get it, pull a fast one. So somebody is truly self-employed and they don't have a CPA. What do you do then?
If they're truly self-employed without a CPA and they are, first of all, it'd be a nod because they found a way to report no income. But secondly, there are other ways to document that. It was Secretary of State, filings, anything of that nature that's public record.
Got it. So in other words, you can go like here in Texas, for example, we can go on to we go on there and we look them up and it shows that in this case, let's say, Joe, Joe, Joe contractor is set up as a self-employed independent person. Okay. What if you're self-employed as like a sole proprietor? I mean,
Mhm.
I'm a guy that's just out there working hard and I'm just Joe Lawn Care and I don't have a LLC set up and I'm just out there doing my thing. Can that guy, if he's not on the Secretary of State, he doesn't have a CPA, how do you document he's self-employed?
Great question. It's normally case by case because that example you sent would be very rare, where it is self-prepare with the sole proprietor. Normally, though, they would probably have some kind of 1099 or contract or anything of that nature, just supplementing the income without actually digging into the tax returns.
Got it. So in other words, that gets a little not gray, but it's not as black and white to where it depends on the person. If they can show a website, maybe get some customer reviews, if they can show that they have a business online presence, things of that nature. Is that kind of what you're saying for that?
Exactly. It's more of when we get an application in, we're kind of peeling back the layers of these onions, right? The first one at the very top of the onion is going to say, okay, it's a bank statement product. And then we do a deeper dive to highlight everything you just talked about and what's needed.
Got it. Okay, cool. So self-employed, got that. Somebody can be, air quote, normal employee that comes in. They're now self-employed. Most likely they're going bank statement because to your point, the tax returns just don't show a lot of net income. They may be making the money, but they're just not showing it in terms of revenue or in terms of, pardon me, profit. So it makes it to where we don't need or want to show the tax returns for some reason. So now we're self-employed. We're going to use bank statements. What do they need in terms of bank statements? How many do they need to show? What are you looking for? What are we looking for? What is the underwriter looking for? Like how many bank statements? What do we need? And how do you determine that?
Yeah, so the first we usually determine how many bank statements we need, or if it's business or personal. We just ask them simply, how do you pay yourself, guys? Does it all come into a separate business account? If it does, we'll get 12 to 24 months for the accounts and analyze the cash flows that way. So we usually recommend 12 is the minimum, 24 is the maximum. And usually the longer the bank statement amounts, the better the pricing or the interest rate associated, because it shows the business has been more stable over a longer period of time.
Yeah. So the more you're showing them, in other words, if you give them 2 years of bank statements, it's obviously we see more, we have more information, air quotes, less risk than if you just showed 12 months. So you do get better terms typically for showing that 24 months versus 12. And you mentioned coming from a business account. So does it have to be a business account or can it be from a personal account? Like going back to my Joe contractor that does lawn stuff, just as Joe Contractors or Joe Lawn Care. Can it be from a personal account?
It absolutely can. Now, the difference being is if they have an actual LLC established, right, with their traditional earnings, maybe it's an 1120, maybe it's a 1065, which, if you're not a CPA, don't worry about it. But our buyers are going to know if they are a true Schedule C sole proprietor or if there's an official partnership set up. But when the statements come in, we say, how do you pay yourself, or how do your vendors pay you? When we ask for the 12 to 24-month statements, they're going to know which accounts that we're going to need.
So if it is going into their personal, we can do it, but I suspect, and I've seen it before, where we get a little, it creates a little bit of hair just because now in your personal account, just random deposits showing up and all your life expenses in there. It's not quite as clean as if somebody were to have these in a separate business account, right? A separate business bank statement showing, Joe Inc. or Joe LLC versus Joe Contractors Lawn Care. But the point is, it can be done. So you can't fix the past, right? You can't go back and rewind 24 months if you're just now doing this. But the reality is, it can be done. We prefer to have it be in the business bank statements. 12 months is better. 12 months is the minimum. 24 months is typically more preferred when we do that. Tell me about like the rest of the term. So as far as, no, I'm sorry, before we move on, the business bank statements, is there one, like, what do you do for an income? Do you just add up the total deposits? Are there multiple ways to do it? What's that look like?
There are multiple ways to do it. Great question. So especially if you have a business account, maybe there's two owners to the business, right? So the normal, easiest way is you take the total deposits that business received over the past 12 months or 24 months or however long it spanned. You take the total earnings, I won't get into the numbers right now, and you divide it by 50%, just with the standard expense ratio is what that's called. So 50% of total deposits is the standard expense ratio if you're 100% owner of the company, right? So if you're 50%, you divide that in half again.
So in other words, the standard expense ratio, is that what you called it? The 50%. So
Mhm.
why do that? So in other words, I know you don't want to, but I'll do it. Let's use total deposits for the last 12 months were 200 grand.
Mhm.
So at 200 grand, you say use 50%. So that means 100,000. So you're saying that 100 grand is what you and the underwriters, I know I'm on your team, but that's what the mortgage world's going to use for the income, is using 50% with that standard expense piece. Is that what I'm hearing?
Correct. And a majority of the time, that 50% is pretty generous, but the underwriters are willing to use that for the standard expense ratio. And then there's two others that you can need if you needed more income than that. So there's
So on the 50% though, they're doing that wise. They just assume that half of what you get has to go out to pay the normal expenses like the rent, utilities, whatever it may be. Is that kind of what they're saying? Is like 50% of what you're doing probably is going to go towards random expenses and you get to keep 50%. Is that where that number's coming from?
right. They assume a 50% margin, the other half's towards business operations, everything you just mentioned as normal.
Got it. Okay. So if now we're at that 100 grand, to your point earlier, if Joe is 50% owner of the company and he owns it with Susie Q, right? Somebody random, not his wife or not anybody else on the loan, because that 100 grand is now the income. That's what you mentioned. You got to half that because if Joe's 50% owner, he gets half of the 100 grand, hence the 50 grand. Did I say that right?
Yep, absolutely. Unless the co-owner of the company is also on our mortgage application, and then
In
you can.
which case, if Joe and Susie Q are married, we can use the full 100 because each one of them gets the 50-50.
You got it.
Got it. Cool. So going in, just for those that are playing at home and want to get real nerdy on this, you said there were two other ways. So one is taking that 50%. What's the second way we could do that if there's another option?
The second way we can do it is in addition to that CPA letter, right, that we needed up front to confirm, companies in existence, they've been around this long, they're still in good operations, and our buyer's percentage ownership. The CPA can take it a step further and do what's known as a standard expense ratio, which the standard expense ratio has to align with the industry. Now, they're not going to go out and check, okay, what's the standard expense ratio on X industry or X company, for example. Having said that, the bank statement investors will consider a CPA letter stating, look, for this line of work for X, Y, and Z purposes, our expense ratio is maybe 20%, right? Maybe it's 30%. So you're no longer having to cut it by 50%. You can do it by the percentiles the CPA itemizes.
Got it. So really, really good point. So with the CPA, and this is the key, the CPA has to give us that number. It can't be Joe Homebuyer. It's got to be the CPA, a professional who's putting their accreditations on the line. But if they can say, listen, in my example, I've been using to say Joe Lawn Care, but maybe Joe's a consultant for company X. Well, as a consultant, you show up to work, you do your job, you get paid. There may not be a lot of overhead and a lot of expenses. So in that case, to your point, Justin, when somebody comes in with a CPA letter says, look, his expenses historically have been 20%, that means we suddenly get a pay bump because instead of using only 50% of the 100 grand, or pardon me, the 200, the 50% took it to 100. Now we get to use 80%. So now we get 160 grand worth of income instead of 100 because of that CPA letter. So I understand that. So the CPA is key in that. So somebody without a CPA, I'm guessing, doesn't get that option. Is that correct?
You got it. Yep. The buyer cannot document their standard expense ratio for the non-QM products. And that's just because, for the sake of qualification purposes,
Sure.
they're just checking their boxes.
Got it. So what's that third option? So number one, to repeat, is a 50%, just cut revenue by 50%, use that as kind of the quote normal. Two is you got a CPA that can hopefully help you, because otherwise you wouldn't submit the information, helps you to be able to use a different expense ratio number, expense, whatever you called it, the expense ratio, we'll call it that. What's the third option?
The third option is, while it's unpopular, it is an option. It's a P&L ratio that's provided from the CPA. But having said that, if the CPA is willing to do, typically we don't see this, and reason being, the CPA, if they can document their expense ratio on a letter for like the second option I mentioned, odds are they're not going to go audit a full year-end P&L for this buyer, much less 2 years, because A, they probably already filed this buyer's tax returns a couple of years ago. And B, if they're going to audit their P&L from the previous year, they're probably just going to go do their tax returns, right?
Yeah. And I think that's tell me if this is possible. I could see that scenario, and I agree with you, because it'd probably be a lot easier for a CPA, a lot less cost. And from a CPA standpoint too, they don't have to charge the borrowers for doing the audit and the P&L versus just saying, hey, here's what's normal. But I suspect, you tell me, like, it would, if I'm now with a new CPA, maybe I haven't had a CPA in years past and I'm now starting to work with one, would that be a scenario where the CPA would want to audit it because they wouldn't feel comfortable giving me the expense ratio letter? Is that kind of, is that normal? Am I making that up? Can we use a new CPA, or does it have to be the same one from years past?
That I haven't had that come up. I have had it to where a buyer has gotten a new CPA within the past year and a half, but maybe the company's been in existence for 4 or 5 years, right? For that example. Now, I would argue though they're probably going to be okay with the typical regular standard expense ratio of 50%, or the CPA may be willing to do the audit for the standard expense ratio. I just think you'd have a tough time with a CPA brand new saying, oh yeah, I just audited their P&L, but here's their percentile. They could do it hypothetically. I like the question because I haven't asked it before. But yes, I wouldn't see why not? Right? You can
And
see.
it goes back to what we said earlier, which is every file is going to be different. Every borrower is unique, and we do have a number of investors, in the industry that do these type of loans. So it's hard to give a generic or an answer that says, "Hey, here's what it is,"
Mhm.
versus, "Hey, give us all the documentation we can to present the story." So I do understand that. So moving on, so understanding there are technically three ways, but really two, right? Two good ways. Let's say that two good ways to calculate the income from 12 to 24 months of bank statements. What does somebody need as far as like when they buy a home? My fault for not asking this in the beginning. I'm assuming they can do this for any home, right? Whether it's a primary home, second home investment. Is there any wacky things that in terms of property or property type or occupancy or anything like that?
No, I mean, primary occupancy, just like a standard mortgage, you're going to have a better interest rate and better terms. Loan to value is up to 90%. So what I mean by that is somebody's buying a $2 million home, they can go up to 90% financing on that $2 million home. So 10%'s got to be your own money. With an investment property or a second home, you're looking at 20% down. So same example, $2 million, you got to put 20% down, 400 grand of your own money for an investment property. But single family homes and condos, yeah, we can do them.
Got it. So normal, air quotes, normal homes, 10% down for owner occupied, 20% for investment homes or second homes. And in terms of credit, like, and again, I know it varies based on investor and things of that nature, but ballpark me, are we talking good, great, grand, get okay, marginal? What do we got to have from a credit score?
660 minimum credit score for all
Six
these
six
products.
zero.
660. You got it.
Hot dang, dude. That's awesome. All right. So bank statement program, 12 to 24 months of bank statements, 10% down on an occupied, 660 credit score. Is it higher for investment properties or second homes? The credit
The,
score
requir-
requirements?
the requirements of the minimum credit score aren't different. What would change in that example is the number of reserves you might need, right? So somebody with a 700 plus credit score, they're not going to need as many reserves. And what I mean by reserves, team, if you have, let's say your total proposed payment is $4,000, right? For somebody with a 660, the investor may want to see like 12 months reserves. So $4,000 times 12, $48,000 in reserves. Reserves are funds in excess of what your required down payment would be for your funds to closing. So someone with a lower credit score, they're going to need more reserves than someone with a higher credit score, simply based on credit history.
That's a really good point. So just to make sure I restate what you said, reserves are the monthly PITI, so the full monthly payment with taxes and insurance. If they need 12 months, just take that. That's what they're going to count as quote unquote reserves. Do those reserves need to be in the business, the same business account? Can they be in their personal account? Can they be in retirement? Where do those reserves need to come from?
You can use reserves in a business account if you're at least 51% owner of the company, right? So that's where they sometimes say, well, I have my business funds. Well, right. But if you're, a 33% owner or even a 50% owner, you can't assume your partners are going to just allow you to dip into that fund to help you pay your mortgage, right?
You got to be able to control. You got to be able to control it and have the voting power to say, "I'm taking this," and screw you guys. Basically,
Yeah,
is what it
exactly.
goes to. Okay,
Yep.
got it. What about from a program standpoint? 30-year fixed, 20-year fixed, 15 arms, all of it. What's out there in terms of for the terms?
30-year fixed. That is the vast majority of these programs for non-QM. There's not a whole lot. I haven't seen a 15-year recently. Doesn't mean they're not out there, but 30 years are going to be the bread and butter for a majority of these
It would
programs.
make sense too, right? Because to do a 15-year, the payment's going to be higher, which means you got to have more and more income. Which in this case, we're doing the bank statement program to try to ease the income qualifications. So what about, are there any prepayment penalties or anything wacky or anything else we need to know about these programs?
For primary residences, we don't have prepayment penalties on these factors. If you would like a prepayment penalty, which some buyers do, some buyers don't, based on really their end goal with the product, right? By its design, it's not necessarily meant to be the permanent product because as rates come down, maybe their tax or their income situation changes. You might be looking to refinance into a more standard product. But to answer your question, we start out with no prepayment penalty in all three. For what I mean by three: primary, second home, investment properties. No prepay penalty unless you want a better rate. Then you can explore, 1, 2, 3, 4-year prepays. If the prepay is in place, makes it a better interest rate. That's the short.
So prepays do exist. not for primary homes, but they do exist on these things. And for those that don't know, the prepayment penalty just means that there may be a penalty if you refinance or pay off this mortgage via a sale or a refi. They can come back and charge you money for doing that. So now this is the part where we get specific to say Justin and I, right? Our professional way of doing the business is to start and present the no prepay option. But for these programs, I think the takeaway is understand that there can be prepayment penalties assessed for second homes and investment properties. So make sure you're asking that question if it's not already brought up in conversation by the mortgage professional. So prepays do exist. 30-year fixed, 10% down owner occupied, 20% for the second homes investment properties. Credit score is 660 or better, which is really impressive for how low that goes. This is really designed for the folks that don't want, can't, don't, whatever you want to say, want to show income documents. What else, Justin? What else am I missing? I feel like we've kind of hit it all, but what else is out there that I need to know about or talk about with this program?
Yeah, the biggest takeaway we get with the programs, and I'll allude to kind of a story, right? As far as rates are concerned with these, because they are higher than your standard traditional, qualified mortgage products. The scenario we paint though is that, and feel free to cut me off or correct me if I butcher it up, but let's say, you're going on a trip, you've got the family packed, family of 5, all the luggage is there, you're going to miss your flight, but you pull up Uber and suddenly you see, well, there's not an Uber X available, but there's an Uber XL or an Uber Black, right? Well, the family's there, so you're going to pay the extra to get in, right? And get to the airport and get time on your flight. The same thing applies to these non-QM products, right? It's not the ideal scenario if you do make a ton of money, but it's the ideal scenario if you're not reporting those earnings to the IRS. So yes, the rate's not going to be what you would want or a standard, qualified mortgage product, but it is a solution to get you in the home that you need and the home that you want to be in without going back and changing your complete business operations just for the sake of getting the financing terms you want.
Yeah, at the end of the day, it's one of those exactly what you said. Do you want to pay the income tax, right? Or do you want to pay a slightly higher rate? So the rate, just to put it in perspective, I'm going to make up a number, Justin, you know better than I do, but I'm going to say the rates for these things could be, let's say 2% higher than what you'd get for a quote normal mortgage. Does 2% sound right? A little higher, a little lower? What are your thoughts?
Could be a little lower than that, especially if you're putting more down. If it's a 20% down, great credit scores, checking all the standard credit, collateral, capital, all those things for the boxes. But sometimes I've seen it to where it's actually maybe even 1.25% higher than standard market, 1.5.
Not as bad as I thought.
Right.
So higher, but again, pick your poison. And a great example, Justin, you and I are working with somebody right now, business owner. At the time we're taping this, it's mid-January, and the guy wants to buy an investment property with his 3 business partners. And mid-January, it's really tough to get all your income taxes done. You really can't. It's too early in the year to get the taxes done, and they think they need it to qualify. This is a perfect product for them where it just keeps it easy, keeps it simple. Yes, they're going to pay, to your point, Justin, 1.5, 2 points more than what they coulda, woulda, shoulda. But at the end of the day, for running a mega business that they do, it just simplifies things and they can close on time, smooth in a matter of a few weeks, as opposed to waiting months to get that done. So, Justin, you are amazing. I appreciate your time. Bank statement programs, guys. Anybody that's self-employed that wants to maybe not show as much income, this is a great product for them. As always, Justin, thank you for your time and thank you for joining us on learning about loans.
You bet.
Thanks, everybody.